Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden language of corporate finances. Today, we're diving into CNL Strategic Residential Credit Incorporated's latest filings. And let's just say they're not exactly rolling in dough right now, but they are making some moves to get there. Ever wondered if a company is just borrowing money left and right? Well, today we're going to break down exactly that. We've got a fascinating look at how they're funding operations and what it could mean for investors. And before we dive in, if you love getting straight up, no fluff analysis of corporate filings, make sure you are subscribed. Also, we've got a fantastic community discussing these reports over on our Discord, which is linked in the description below. So, what exactly is CNL Strategic Residential Credit Incorporated? Think of them as a company focused on residential real estate credit. They're essentially involved in lending related to homes, and like many businesses, they need money to operate and grow. Now, the big news here is about a loan. On the 31st of December 2025, CNL Strategic Residential Credit Incorporated, or as we'll call them, the company, inked a deal with Valley National Bank. This isn't just any small loan, it is a revolving line of credit, which basically means they can draw money as they need it, up to a certain limit and then pay it back and draw again. The maximum they can borrow is a cool $15 million. But here is where it gets interesting. How much they can actually borrow, what they call the available borrowing base, changes before they close their first big private offering. It is tied to 60% of the capital that investors have committed but haven't yet paid in. Once that offering is closed, it shifts to 100% of the money held by their escrow agent. Bank Dani, this tells us their immediate cash needs are closely linked to investor commitments and actual funds held, not just a blanket credit line. When they do borrow money, they'll pay interest. The rate is based on the Secured Overnight Financing Rate, or SOFR, which is a benchmark interest rate plus an additional 2.75%. SOFR can fluctuate, so their interest costs will also change over time. This is pretty standard for business loans, but it means their expenses can go up or down, depending on broader market rates. The terms of the loan are important. Any money they borrow under this line of credit has to be paid back either within 90 days of when they borrowed it, or by the final maturity date of the line of credit itself. And speaking of maturity, this line of credit is set to expire on the 31st of December 2026, unless it is extended. That means they have a specific time frame to use this borrowing capacity, and crucially, to repay it. To get this line of credit, the company had to pay Valley National Bank a commitment fee of $37,500 up front. Plus, they had to cover the bank's expenses for setting it all up. This is a cost of doing business, showing they value having this flexible funding source available. Now, having a loan agreement usually comes with strings attached, and this is no exception. The company has agreed to certain covenants, which are basically promises to do or not do certain things. They have to provide financial and compliance reports to Valley National Bank regularly. Keeping these covenants is crucial to avoid defaulting on the loan. A key part of this agreement is that the company needs to maintain accounts with Valley National Bank. Even more importantly, proceeds from their offerings are pledged. This means if they owe money on this line of credit, those offering proceeds can be used to pay down the debt. This is a strong indicator that the loan is directly tied to their fundraising efforts and investor money. This filing also officially flags the creation of a direct financial obligation. Essentially, that loan agreement we just discussed means the company now has a direct financial responsibility to Valley National Bank. It is not off to the side, it is front and center on their balance sheet as debt. And finally, as is standard practice, they're listing the exhibits associated with this filing. This includes the actual loan agreement itself, which is Exhibit 10.1, and the interactive data file for the cover page. Like most corporate filings, there is a section dedicated to forward-looking statements. This is essentially a legal disclaimer. The company is telling you that when they talk about future plans, expectations, or projections, these are not guarantees. They're based on current information and beliefs. But actual results can be very different due to risks and uncertainties. They explicitly state they have no obligation to update these statements if things change. They highlight some of the key risks they face. This includes their ability to pay out distributions to shareholders and where that money will come from. They also mention the general economic and financial market conditions, which can have a significant impact on their business, their earnings, and the value of their assets. Other risks are detailed in their previous filings with the Securities and Exchange Commission, which is what we're looking at today. Signing off on this report is Chirag J. Bavsa, the Chief Executive Officer. This confirms that the information presented has been reviewed and authorized by the company's top leadership. So, what is the story here? CNL Strategic Residential Credit Incorporated is securing essential funding through a revolving line of credit. This $15 million facility with Valley National Bank is a lifeline, especially as they look to close their initial private offering. The structure of the borrowing base tied to investor commitments and escrowed funds shows a clear link between fundraising success and their ability to access capital. The interest rate is variable and the loan matures in about a year, meaning they'll need to manage their cash flow carefully to repay it. The collateral pledge using offering proceeds to pay down debt is a strong sign of their commitment to managing this borrowing responsibly. Looking at the bigger picture, this loan isn't necessarily a sign of weakness, but rather a strategic move to ensure operational flexibility and funding availability. The company is proactively managing its capital structure. The risks they mention, like market conditions and distribution payments, are typical for real estate investment companies. The key will be how effectively they can deploy this capital into suitable investments and generate returns that not only cover their costs, including interest payments, but also allow them to grow and eventually distribute profits to their investors. In conclusion, CNL Strategic Residential Credit Incorporated is taking a measured approach to financing its operations. This line of credit provides a valuable resource, but it comes with the responsibility of careful management and timely repayment. Investors should keep a close eye on their fundraising progress and how successfully they deploy these borrowed funds. Alright, that is our deep dive into CNL Strategic Residential Credit Incorporated's latest filing. What is your take on this loan agreement and what it means for the company's future? Drop your thoughts in the comments below. If you found this analysis valuable, please hit that like button. It really helps us out and signals to YouTube that you want more content like this. And of course, subscribe for more corporate breakdowns. Don't forget to check out our Discord community linked in the description where we dig even deeper. Thanks for watching and we'll see you in the next decode.